Good afternoon. This is Brad Dennis with BIS Commodities and your weekly update. This is for the first week of December here, 2013. Interesting week with maybe more of the macro markets than anything else. As far as livestock are concerned, we'll start out there. Still within your range in your December cattle. You're talking about a $2 range of 131.50 to 133.50. Little bit of trade today, but mostly the show lists are pretty long, so don't expect a whole lot of breakouts there in the near term. You're looking at hogs, though, breaking out to the downside, and that is putting a little bit of pressure on the cattle market. But for the most part, with the holiday season and such, I would imagine we'll probably continue with this $2 range out there. Like I said, the hogs took out the technical side. On the February hogs, 89.50, 89.60 area was taken out this week, so we're going to have to see that as a slight resistance from a technical standpoint. See if it gets down to its, I believe it's its 200-day moving average down there at 85 or not. We do have a little bit of a bottom forming out here, so if we take that out early next week, I would imagine that you could see that technical move to the downside. Kind of surprising, excuse me, that we didn't see a little bit more of a rebound in cattle this week, just because of the ice and snow down south. Usually you have a little bit of weather premium put in there when that situation comes around, and I believe Dallas was getting a lot, so was Oklahoma today. So I'm kind of surprised that we're not seeing that premium in there. So if we can't get a weather rally out there, what are we going to get on the cattle side? It seems to me that demand isn't going to be helping out all that much. So once again, same kind of range, maybe push that lower end of the range. In the energies, very cold weather has been coming in. That helped the heating oil stay up around that 306 area. In crude, we saw the stock market rally some, so that has supported crude. And then also in crude, there's a little bit of fear about the opening of the Keystone line, the reverse flow from Cushing down to the Texas refineries, and the fear there is that you start pumping that oil down there, they're going to refine it very quickly, and all of a sudden our supplies are going to be gone. So you took crude down to $92. Now we're back up to about 97. How much more do we have to go? When you look at the world perspective, you know that OPEC isn't going to stop pumping. You know that we're not going to stop producing. So it's not for a lack of supply. It's an anticipation over U.S. supplies dwindling down because of a pipeline that is given a little bit of a boost. So keep that in mind. Also, we're looking at a little bit better usage in gasoline, but not enough to warrant a $5 rally in the crude oil market. I think one of the factors that you got to look at is that crude has been down this year to a point where, hey, last month of the year, people are taking profits, maybe a little bit of short covering out there. Equities. Equities again today, you had a 100-day or 100-point rally in the Dow. S&P 500, we're looking at 1804 right now. Its highest close has been 1804. So we're right around those very lofty levels. Why are we there? Well, we had good GDP data the other day, 3.6%, which blew out expectations. And then this morning we came in, we had 203,000 for non-farm payrolls with 7% unemployment rate. Now, the unemployment rate, I'm not even going to address that. I think that that's fluff. 203,000 jobs is better than what was expected out there. So we're creating more jobs. Now, in a healthy economy, that's not spectacular. But in our economy these days, 200,000 is decent. And and it shows towards growth. Does it show enough growth to say, hey, we're going to see early tapering? Probably not. We do have a Fed meeting coming up the 16th and 17th of this month, and it'll be Bernanke's last as head of the Federal Reserve. So at that meeting, do you think he's going to change his policy at all? No. He's going to let things lay and let Yellen take over next year. Now, the interesting thing about this all, though, is that early on when we started doing the $85 billion worth of buybacks, you had him point out to getting to 7% on the unemployment rate before those buybacks started to slow down. So does he stick to his old guns? Does he say, you know what, I'm done with this job, I'm gone? Or does he say, you know what, that's, that level, that 7% unemployment level has gone down? And I would think that the latter is the case, and we just have steady policy going into the end of the year and have to continue to see this improvement before we see any kind of tapering out there. And remember, if the Fed does come in and start to taper things a little bit, meaning their buybacks come back, they always have the overnight rate that they can lower, and they've already mentioned that. So you take one stimulus area out, you put in another stimulus area to get these banks to lend out money, and that's how they'll probably treat the whole thing. So easy money policy going forward, helping out the equities at some very high levels. Not to say people aren't going to take some profits before the end of the year, but I think any kind of pullback in the equity markets will probably be bought up at this time. Moving on to the grains, talking about corn, talking about beans. Corn. All right, we ended up trading and closing up maybe a penny in corn today for having most of the day lower. What we saw this week was very interesting. All right, you come in the first day, you make new lows for the downward move, and then we start to rally. And we rally up, we take out our 20-day moving average, and we ended up closing above that at end of the week. News that came out this week, all bearish. You're looking at China rejecting cargoes of corn from the U.S. because of a certain gene. Those cargoes are trying to be sold into different Asian destinations and at a huge discount. So exporters don't want to export anything to China until they figure out, what can pass inspection out there. You've got cargoes that have no home right now, so you've got a lot of cheap grain out there, but still we're seeing the corn market rally about a dime this week. Well, I think a lot of that has to do with the short position out of the fund and the end of the year. First 3 days of the month, 3-day period that funds like to work in, funds came in, they covered some of their excessive shorts, and we're able to take profits for the end of the year. Have we really done any damage to the upside? No, we haven't done any kind of reversals out there. And until that happens at a point which is much higher, probably around 350 or so basis the March, you're still going to have any kind of price appreciation in corn being taken care of through basis. You look at basis here in Iowa, specifically Cedar Rapids, where we have some of the best basis in the world or in the country, and that basis has come down. We've transferred over to the March contract, and bottom line is 440 to 450 in cash is buying enough corn to keep these processors well supplied. Moving on to beans, kind of a similar situation, although beans closed lower on the week. A lot of talk about what's happening over in China with beans. All right, so we've got a flotilla of beans going over there. ton of beans that are coming into the country, and the government is making it harder for the importers of beans to turn around, take those cheap beans that they bought from the U.S. and resell them internally at like a $6 premium. So without that arbitrage that these importers are able to do, it takes away a lot of demand for beans. And we're hearing that there are some companies or importers in China that are trying to sell out cargoes. Now, this hasn't made it to the news wires all that much, but we're hearing and we're realizing that there's a ton of beans over there, and some of them are trying to find a home. Now, the other thing that we're looking at with beans as well is that the rally that happened in the U.S. has not been seen in China at all. Those bean prices continue to come down. So from that perspective, maybe we did cap beans this week at that 1340 level. A lot of push for beans this week, as on Tuesday it looks like the river's going to be closing down. So I think that there were a lot of people that were doing their last buying, gave us a boost, and then it was done. You look at the export sales that were announced this week, and other than I think 111,000 metric ton of new crop, we only had today's announcement was 385,000, which was a huge number, but that's what we need to do on a regular basis to account for the big sales that we know are going to go to China. Bottom line is they're starting to slow down, and there's a seasonal pattern to them slowing down. So when I look at beans, I'm looking at, all right, they're starting to slow down. China is, they're the biggest buyer. Yes, we have domestic crush going on, but that's slowing down as well because the river isn't taking any beans down south, so they're going to be the biggest buyers out there. And technically, you basically have to get your GN beans back down below that 1311 area to have any significant pullback. After 1311, then you're looking at that 1290 level. A close under 1290 opens up the door for a lot more selling out there. I say that just because of the way that this market has been moving back from the 1260 to 1330 area. Okay, we expanded our upside horizons a little bit. Now, if we get back down through that pivot point, you definitely could see more sellers come in or funds liquidating their long positions. Look at the spreads. Spreads continue to move down this week. So you're not seeing those exporters bidding up for beans, and from what we're hearing, most exporters have bought beans throughout the month of December. So watch the seasonals on that. I would look for spreads as well as GNs to start to pull back on that. Other than that, like I said, up a dime in corn. It felt like we were up 50 cents because we finally had a bounce in corn, but it was only a dime in corn. And then as far as beans are concerned, down in that, and I would imagine that we're going to continue to see beans fall off towards the end of the year, whereas corn basis the March probably go down and test that 420 area before the end of the year. So that is all I have from BIS Commodities for this week. Thanks for watching. Broadcast out.